Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
Good morning, everybody. Welcome to this Thursday edition of Benzinga's Pre-Market Prep. Spencer Israel, Joel Elconin, Dennis Dick with you this morning. Stamps.com is a lesson that it can always get worse. So I'll probably lead with that this morning, but we got a lot to get to on the earnings front. Disney, ROKU, a couple pot stocks reporting, Duke Energy, ELF. So some interesting earnings reports to get to on our show. We'll also talk about the Intel guidance from yesterday and the Fox TSG sports betting partnership. Our guest today is Greg Weldon from Weldon Financial. He will join us in about a half hour at 8:35. Joel, what is the word here overnight?
Red again is all I can say. It chopped around yesterday. Ended the session at 87.25. That seems far away now. Lower open, pre-market high 85.5. I think that's safe for today. Pre-market low is 58 even. That is taking out Tuesday's low at 62.5. So there's some levels to keep an eye on the downside. My next number on the downside, 28.44.50. That's your April 1st low. That's not too far away, folks. Crude in the red here by 21 cents, finding sellers in the lower to mid 62.5, 62 handle. Gold in the green by $1 at 12.82.5. Silver down a dime at 14.76. And don't look now, here comes Bitcoin futures over that 6,000 level, up $155 at 6,035. Triple D, another down open.
There's just so many unknowns here, but look at the bad news yesterday. I mean, and yeah, they're coming in and they were buying stocks for a while, but that Intel news at the end of the day, that's real bad. I mean, for the entire chip sector, not just for Intel. So give us that headline. They broke this, and obviously with about 15 minutes, it was at the investors conference, and it was just terrible commentary. Give us those highlights, Spencer.
Yeah, they had their investor day yesterday, and then at around, the 3 o'clock to 3:30 window there, the CEO was giving some remarks. They said they expect low single-digit revenue growth over the next 3 years. He gave some more numbers there, but earnings growth let me read this headline. He says they see earnings per share of $6 by the fiscal years 2022 and 2023. And the earnings growth is going to be in line with revenue growth, which we said right there was it's low single digits for the next 3 years.
What do they make right now? So $6. What are they? Do we know what they make right now?
Yeah, I can pull it up for you real quick. They made in the last quarter, they made 89 cents. So last fiscal year, 2018, they made about $4, $4.50.
So long term, they see some growth, but it was this short-term commentary, and we know this market cares a lot about the short-term, and short-term is not that short when you're talking about 3 years. So they said low single-digit growth for the next 3 years.
That's what they said.
Yeah, this is on that. So anyways, I have an Intel position. I sold a good chunk of that position on this headline yesterday, and I'm glad I did. I ended up, and I didn't get the best price, but I got a better price. I sold, I think, around $49.40. So I'm glad. I wish I would sold the whole thing, because you're trying to react fast. It's a long-term position. You're trying not to trade your long-term positions, but come on, you're telling me you're not gonna have any growth really for the next 3 years? Well, why do I want to invest in you if you're telling me you're not going to grow for the next 3 years? I'm not sitting around here waiting for 5 years or 7 years or whatever your time frame is until you start getting growth again. You're telling me the growth is not going to be there for the next 3 years. Well, I'll come by in 2.5 when you start to turn around. So, I mean, that's just the worst thing. Like, it's one thing to give guidance and say, okay, the next quarter looks weak. It's another thing to give guidance and say the next 3 years look weak. That's basically what they said. So, I mean, this was a stock that I was way up in. And I've come back and given all the gain back, which is disappointing, obviously. But sometimes you just got to say, well, look, I don't want to start eating into my own profits here. this story looks broken, at least for the near term, and not even the near term. If they're telling me the next 3 years. So maybe you keep a piece in the long-term portfolio, long term, but there's no reason to be overinvested in Intel right now. And I think that's what you're seeing here this morning as they wake up. You did get a downgrade from BMO, but people waking up saying, why do I want to be invested in something that's telling me low single-digit growth for the next 3 years? And this is not good for chips either. The chips already look broken. So if you look at SMH, it's been leaking here. But I mean, you start looking at the individual stocks, NVIDIA, AMD is held up better because AMD is AMD. But I mean, you look at all the other ones, they're all starting to look weak too. And now you get this commentary from Intel. I don't think it helps any of the chips. I think it's a big reason, the market's down here today, but the chips are leading the way. And I think this is a big reason behind it.
All right, trading lower in the pre-market. I'm just trying to look at the day that it popped over $59. Was that the day that it had the same day as the Qualcomm news?
I can't remember what the headline was, but that was, in hindsight's 2020, but that was a selling opportunity. I thought about lightening up that day. I really did, because it had been, I'd run from 50 to 59 in basically a month and a half, which is a big move for Intel. But I was like, don't trade your long-term portfolio. Hold on to this thing. And now the story, they come out with disappointing earnings. Here they are 10 days later, and they're telling us it isn't going to get any better for the next 3 years. I mean, now you've just got to if you're in it, basically got to eat your loss, or, book whatever profits you have left, in my opinion. I mean, maybe this is going to be the bottom. Maybe they're going to turn around, but it's not like they said they're going to have a bad quarter. They said they're going to have a bad 3 years. It's a long time.
And on that day with the Qualcomm and Apple news or something, I thought they announced they were getting out of something. Was it the 5G arena?
Yes,
was that
that's what it was.
Maybe that wasn't such a good idea to get out of that 5G arena, but
I mean, it was burning money. Maybe it was the writing was on the wall, though, that they, obviously they're looking at what is not burning money here. Or what is burning money? We don't want to be burning money here. Obviously, it's still making money. It's not, a situation where they need to raise cash or anything, but they're trying to improve their, overall growth here. It was, an area that was not working for them. So, so they bailed on it, and the market applauded that day. But, maybe the writing was on the wall. They're bailing in this area because 5 days later they were going to, disappoint on earnings and warn. And now we get 10 days later and it sounds like a long warning. So I'm just shocked, on that earnings report that they take it down 9%. And then on this news yesterday, maybe it was just because the people didn't have time to adjust to it, but only taking it down a point on that. I was like, that's way worse than what they said in the earnings. So I can't see why this thing, turns around and comes back up right away. So if you're coming here buying the Intel dip today, I think you're wrong.
$48. That's right where we're trading, and they took it down to that area. Pre-market low was right in this area too, 47.90. 48 was a level. That is the low. No, it's not quite the low for the year, but I see a low at 48.05 on January 11th, and then you can see your other daily lows, 47.41, and then I guess if I was holding out for a little bit more, I'd like to see what happens under 47, see if they could take it that low. Pair of lows, 46.75 and 46.78 for January 7th and 8th of this year. So those are touch of support levels, but I have to agree with you. 3 years out, I mean, that's not a quarter. That's not 2 quarters. It's not a year.
Terrible comments.
Yeah. I don't think I've ever heard comments like that before. Coming out 3 years.
Not 3 years out, like low single-digit growth. So they're not telling you but it doesn't sound good. So anyway, I think that's why, and I wouldn't be surprised if more downgrades coming on the way here too. I'm actually surprised we only got one overnight with BMO. So because if we go look at Intel, it's always curious. Let's go look at the analysts and look for potential downgrades coming. If we go and we look at the ratings, current ratings, we have, bringing it up. Well, okay, so it's very mixed actually. I have a lot of coverage on Intel, obviously. I've got 15 buys, 19 holds, and 7 sells. Well, all those holds, could move to sell. Some of those buys could go to holds. There's some potential for some downgrades coming here. So this is why when you've got a story that appears to be at least broken for the next while, it's no reason to be in the stock. And that's why I lightened up yesterday. I'm probably going to dump it all. Maybe I hold a little piece of the action, but I'm basically even. So from where I bought it just 6 months ago. So maybe sometimes you just admit, hey, okay, I had a nice run. I didn't get out in time, but I'm not going to let this, turn into a big loser for me in my portfolio.
All right, and should we just?
I mean, it's still got to think valuation is still attractive. I mean, from a valuation perspective, even if they're making $4, $4 or $5, it's still fair. It's still a cheap stock, but it's cheap for a reason.
You know what though? Remember that they have a new CEO, right? Robert Swan has been on the job less than a year. Took over in June.
Maybe they should not allow. Who was it? Was it him that was doing this commentary?
Yeah.
Talking 3 years out.
Yeah, June 21st.
I guess transparency is nice.
Yes,
but
being transparent. June 21st.
Transparency is nice, but holy cow, just terrible comments.
June 21st, 2018 is when he took over as CEO of Intel. And they're ripping the Band-Aid off, right? Same thing that they did with the 5G thing. They're just ripping the Band-Aid off. We're going to give you the bad news. We'll get out of the way, and then
lower expectations.
Lower expectations. And I guess in a few years here.
I think it's bad news for all the chips.
Okay.
I think this may not just be an Intel thing here either. So the chips have had a nice year. I've got some gains in some of these other chips. I might book those too. I think it's bad news for all the chips.
All right, let's just take a quick look. AMD. We talked about a lot of stocks that had that earnings pop and then came back and gave it all back to fill the gap. That's the situation here with AMD. You're filling that gap from earnings at 26.80. We'll see if it holds in there. If not, the next support level for Intel, 26. I like 26 for Intel because you got a low at 25.83 and 26.
AMD, I mean.
Yeah, AMD. And
if Intel goes to 26, I'll buy it.
Today? Or
if it goes to 26, I'll buy it. Whatever day it goes there. That's low enough that I'm interested.
Okay.
But I'm not interested at 48.
I gotcha. And NVIDIA, big support at 170. It's holding it above that. It's just really dead pre-market action in this one. So under 170, I would be look out on the downside here in NVIDIA.
I'm torn, on these chips. I own NVIDIA. And you can go to Applied Materials and stuff a little bit different, but I own Micron. I own Intel, which I obviously sold a big chunk of yesterday. I might sell it all today. I'm really torn here. You want some exposure, but at the same time, this is just commentary that makes you not interested in buying any of these things. I mean, there's people coming here that are going to be obviously the buyers today. I mean, Intel's traded a ton of stock already. So, for every buyer, there's a seller. It's already 228,000 shares have been bought. And I think it's a mistake. And I mean, I'm still talking against my book because I still own a little piece of this. But I mean, I talked against this at 51, 52. Somebody was asking me, do you start adding to it or buying more? And I was like, I don't think so. I wish I would have just, sold it out, and I was actually still sitting at a profit, but it didn't sound that bad. Here you got guidance for a quarter or two, and you think, okay, it's gonna be weaker. When they say 3 years, it's too long to wait, in my opinion.
All right,
that's why I think the stock's getting hit.
Let's move on to the worst news this morning. Stamps.com. So 3 months ago, it's okay. I guess in this case you're allowed to laugh. 3 months ago, the company came out, said that they were ending their exclusive partnership with the U.S. Postal Service. They lowered their fiscal year guidance, the EPS guidance 3 months ago from $10 to $5 to $6. Well, yesterday they lowered their guidance again from that $5 to $6 range to a range of $3 to $4. And so they're now down 80% on the year or thereabouts. And this is a lesson that it can always get worse. That's kind of how I'm looking at this.
So you got a broken business model here, in my opinion. I mean, we've talked about this before after the earnings the first time around. People are, there's people asking the question about stamps. Obviously, see stock fall 50% one day, you think, oh, it's on sale. But I mean, you're a company that deals, and with exclusively pretty much here with the U.S. Postal Service, and you lose that contract. And this is the majority of your business. I mean, yes, they want to sell other products, so it was the exclusivity. Yes, they're still selling stamps, but I mean, this is just a mess. This business model is a mess here right now. And when business models are broken, there's no reason to come in and buy the stock. I don't see this coming back and going to 50 or 60 anytime soon here either. So if they get the turnaround, get the contract back with the U.S. Postal Service, then I'd be interested. I mean, then it's going to get a big pop if that was to happen. But I don't see that happening. So, this contract that they had, this exclusive contract they had, was obviously the reason for the sell-off in February when they lost that. And now they're trying to reinvent themselves here to a certain extent without that contract. And it's going to be a difficult thing for them to do. So stock's down another 46%. I mean, stocks are broken with broken business models. No reason to own them. And there was no reason to own this thing at 83. The day after it fell, it hung out there for 2 months.
Just hung out there.
It's still broken.
No bounce. I mean, it had.
Why would there? I don't understand the reason. Give me a catalyst. The only catalyst I can fathom that this would bounce is if they get that contract back. And maybe they do. Maybe that's why you don't short it, because if they do, the thing could be up like 50% overnight. I don't see that coming.
If they partner with like an Amazon, but
they're selling Amazon products and FedEx, like they're selling those products. So yeah, maybe they're going to try to figure it out. But until they do, it's just too much of a gamble. I mean, even if they get a good deal now, if you bought this at 83 yesterday, good luck. I mean, it's got to double to get back to where it just was. When a stock falls 50%, it has to go up 100% for you to get your money back. Hard to do.
And spinners, we were talking about this on the desk. Basically, 2-for-1 stock splits over the last 2 quarters.
The mess.
I'll just give you one level.
Oh yeah, give us a level.
I'm giving you a level.
You found a level.
This is not me. This is just what the charts. I'm looking at the charts, and the charts are telling me this level. I didn't make this up.
All right.
Couple monthly lows in January and February of 2015, 44.13 and 44.20. You're hanging out there. That's all you're doing. You're hanging out there, 44. Underneath that, if I had any kind of short position, I mean, 36.41 was your November low, if you go back on that. But I think the only way you're going to catch a low on this one is if you're just using like the half and whole numbers, with bids,
Why even try to?
I'm not going. If I would, so if you were,
but when we talk like this, there's people thinking all of a sudden, oh yeah, maybe I should try to catch a low. This natural human tendency to want to buy a stock that is cheap. They think it's 50% off. Okay, all the bad news is in this. I'm, safe here now. Why? And I'm going to come in here at 44. Eventually, it's going back to 85. That's the natural thought process of an unsophisticated investor, which there is a lot of unsophisticated investors out there. But you look at this, and you could have had that same thought process for the last 2 months, saying this was a $200 stock. It's 83 now. I think eventually it's going back. What's my downside? Your downside is 50%. Let me tell you something. Okay, do the math. If you bought this thing at 200 and it's at 44, what are you down, like 68%? Well, if you bought this thing at 85 just a couple weeks ago, it's at 44. You're down like 50%. You're almost in bad as shape as a guy that bought at 200 from a percentage basis if you put the same amount of money in it. So it's tough. The stocks that are broken stay broken until there's either fundamental news that changes the story, or maybe the overall market helps it out or something. But there's just no reason to try to call a bottom on this. I mean, people coming here buying this at 44 today are saying it's going to bounce up to 47, 48, 50. Maybe get a bounce. I mean, we had a bounce a couple of days, and if you're a day trader, you can day trade anything. But if you're a long-term investor putting this in your long-term portfolio and saying I buy this at 44 because how bad can it get? Well, the thing could be at $20 in 6 months. Who knows? I mean, it's broken. So I almost think if as a long-term investor, don't buy broken business models. And that's what you're doing if you're buying the stock right now. And maybe it comes back. The one wild card is if they get that contract back, but it's got major problems here right now.
You know what's crazy to me? Sorry to interrupt, Joel.
That's
but
okay.
In 2 quarters, their EPS guidance has gone from $10 of earnings to, we'll call it $4 of earnings. $10 to $4 in 2 quarters. They've cut their earning EPS guidance by. That's insane.
So it's just following along a multiple, $10 to $4. Okay, well that makes sense. So you're trading at a 20 multiple. Now you're trading at a 10 multiple, but now you're not even not growing. You're significantly declining earnings here. So you can say, oh yeah, but it could just be another value trap here at $44. So tough. I mean, you can trade anything. Have yourself an out. If you are trying to call a bottom here, have yourself an out. I don't know how you find the out. because this thing could really, it's going to move again. I mean, just because it went from 83 to 44 doesn't mean it's going to go 40, but it could go to 40 today. It could, and you lose 10% of your money. I mean, I'd say let the dust settle if you want to try to call a bottom on this, but scary stock to try to call a bottom on.
Yeah, I mean, that's about all I can say.
Lots of rants here today. Intel continues to fall here in the pre-market, so it's down 3% here. So we've been trash talking it since that quarter, but I mean now I don't even know what to say. I'm disappointed because I had it and I should have dumped it right on that earnings report. And obviously hindsight's 2020. I'm glad I dumped a big chunk of it yesterday before the close, but I mean, and that again, this is just showing you two stocks that are broken right now.
Yeah, I mean, if anything here, I think the biggest takeaway from this is like, you're not color coding this. You had this in your portfolio. The reasons that it was in your portfolio, and you just made a decision, and based on the information that you have, and I
should have sold it all.
Right.
I kept a little piece because you think, okay, it's still a value, it's still on, but it's ticking me off that I even have a piece left.
Right.
So.
Can we talk about some good news in I guess I could say our portfolio?
Yeah, in our portfolio, me and Joel, let's do it.
Go ahead.
Finally, because my portfolio has been under attack. At least my long-term portfolio has been under attack, I feel like, this earnings quarter. So I had some good news here overnight. Give us that good news if you know which stock we're talking about, Mr. Israel.
This is the joint Joel Dennis portfolio that I didn't know existed until just now. But
the one stock I think we have together.
The one stock you have, you both, I guess, own the Stars Group, and congratulations on both of you. TSG reported a partnership yesterday with Fox as far as sports betting is concerned. And let me see what the headline was. It was just a sports betting deal with Fox. That's basically all you need to know. You hear sports betting, that's all you need to know.
I mean, you look here, TSG, me and Joel were on this way too early. I like the story. Obviously, Fox likes the story too. They've come in here now, but we are way too early on this. So I'm actually still down in this because here I was trying to call a bottom on a stock that was broken because I like the story. Well, I'll wait until it starts the bottom. Don't try to be a hero. And this is, maybe what Joel and I both did wrong was trying to, the stock went from 37 down to 25. I still like the story, and I thought that, 25 was a good price. Well, I watched the thing go down to 15. Now it's back at 21, 22. So we're getting a chunk of our money back. But, I mean, it's still not a happy ending here for me or Joel in this stock because we were way too early on it. So that's it's a good example of trying to catch that falling knife and saying, okay, it's cheap enough now, I'm going to buy it. I mean, if we would have waited till it stabilized at the end of 2019 and then retest that bottom of 15, we'd probably be in a lot better entry position. But we didn't. We jumped the gun in it too early. I thought there was value at 25. I was obviously wrong. And now it comes back. It's good news. I mean, this is good news. Fox partnership. It's probably a stock that maybe holds on to some of these gains because this is pretty good news. But again, just don't be too early on a trade.
Yeah, and it's a pop here. I'm holding on. It got up in the pre-market trading to 22.52. It's faded a little bit. So the day trader, short-term trader in me says if it doesn't get through 22 here, it's going to fade. Way off that pre-market high, 22.52. The longer-term investor in me would say, man, I'd like to see this come back in a little bit. I don't know if I'm ever going to get to see a gap fill at $18, but I think maybe more inclined to try and buy some more on a pullback. Not selling it here on this pop. This is something I'll be holding on to for a long time. All right. And you know what hurt us? Wasn't there a vote, Dennis, that something about Florida?
Yeah,
that's there.
I mean, we just like the story, and me and Joe a little bit of gamblers, and I guess, but it's sports betting, so we kind of this felt like the pure play for it, and it was. We're just too early on the trade. We were too early.
Just for a quick update, Ryan Craver was the guest that we had on, and I just messaged him here real quickly. He can't make it on today. He said he exited the stock a couple weeks back.
We're back to Stamps now.
Back to Stamps.com. And he says, as for Stamps specifically, I will pick up a small position today. We use their software for our daily direct consumer e-commerce business. No longer have exclusivity. Hurts, but he thinks this is overdone.
So I think there, and he was on our show the day of the original guidance cut in February, and you know, he said he knows the business, he uses it, and it's someone who he's in it because he knows it, and
he's trying again.
He interacts with it, so you definitely feel it's hard to overcome. You know, like when you interact with the business on a daily basis, you know, it's hard to overcome that inherent bias of the, you know, like you think you understand it, or you. And I'm not saying Ryan is ultimately going to be wrong here. We don't really know. I mean, so far he's very, very wrong, but it's hard to overcome that inherent bias of when you interact with a product or a company day to day, you think that you know what's happening, and you think you know more than others do.
The market. Yep.
So, right. So it's hard to overcome that bias. Let's move on here to Disney. Disney had earnings yesterday after the close. I'll read you those numbers.
I was just gonna. Yeah, I keep getting cut off here, and I have the opposite impact here. Is I have a hard time liking Microsoft stock because the Skype product they have keeps dropping the bloody call.
But that's one example. That's one example.
The opposite. Dennis, this is the opposite.
No, but that's one example. I feel like the products that I don't know what stuff you use, Dennis, or like for your trading, but if any of it is publicly traded, and you feel like you like Virtue is a good example. You know,
it is.
You do what Virtue does on a much smaller scale, so you think you understand them. And that's why you're bullish, and that's fine. That's a perfectly good bias to have. It's a good reason. I mean, it's a good reason as any to go long a stock. But it's hard to. My point is, it's hard to overcome that inherent bias when you interact with something. So
that's a good point. It's hard for me to overcome this inherent bias of not liking Microsoft because Skype keeps messing up Chevron.
All right.
It will not increase the offer for Anadarko. Chevron popping here right now.
Yep.
CVX will not increase. CVX is increasing their share buyback by 25% to $5 billion. All these headlines breaking right now. We give you the information as it breaks. Anadarko is coming down on this. OXY is coming significantly down on this because they've obviously won the battle here now. Chevron is out. Chevron is popping $4 here on this news.
Chevron also getting a $1 billion termination fee.
Yeah, which we knew was going to come if they were out. So that's these are the headlines that are breaking right now. This is broke at 826. Yep.
They're getting the billion, huh? Well, could someone call Occidental and tell them they don't have to come up with a higher bid again?
If Occidental comes out and trumps their own bid again, that'd be the craziest thing I've ever seen. They've won. So OXY wins, but shareholders lose apparently because down 3.75%. You know what? I wanted to buy Chevron just because I thought this news. This was predictable. This was so predictable that this was going to be coming. I mean, they already sounded like, that they were out, and, now that they're officially out here, the market applauds it, that they're not going to pay the big premium. And think about it. It went from 125 down to like 120. Now we've got a little weaker on the USO since then too. So you got to reprice that in there as well. So if you're coming here buying 122 here today, I think you're chasing news. I think it's more of a fade. So my opinion here, just my opinion, and obviously this news is just breaking, but if I was trading this thing just as a trade, I'd be a seller at 122. And we'll see where, as a day trade here, but saying, I think when I look at this thing, depending on where oil is, obviously, but if oil, is still where it is, I think this thing fades back. So a paper trade 122 shorts Chevron. Okay. No actual position.
122 is your
I know there's a bid there, so that's why I said I was paper trading at 122. I hit that bid on paper. We'll see how I do. I've ever made paper trades before.
We'll probably be a big winner.
I didn't put real money in it.
The key level for that, I see the pop over 122. For me, the level of interest is 122.54, and that's because when you did have the original news come out, they hit it, and that's been the rebound high, 122.24 or 122.54. And then you got the gap to fill up all the way to 124.75. The reason I'm not looking for that 124.75 is what Dennis mentioned here, a little weaker USO, just a little weaker market. Market sentiment has changed a little bit. And another reason why I don't think I'd be an aggressive buyer of this is, who knows? They might go out. This is total speculation, but, maybe they're going to look at somebody else in the sector.
It's possible.
Yeah, possible.
We've given those targets before, and Kramer's done a nice job of it. Pioneer Natural Resources was one that he cited. He'd also cited Apache. I do have a position in Apache, although I kind of wish I didn't. They had a disappointing earnings report too. But we know my portfolio, every single stock in my portfolio disappointed. It seemed like last earnings season stuff. Anyways, I won't complain. I'll get away from complaining about my own personal portfolio.
All right, let's go back to Disney here. About 5 minutes before we're going to grab our guest, and let's read those Disney numbers. Like I said yesterday, after the bell, they reported Q2 EPS of $1.61 versus $1.58 estimate. Sales of $14.92 versus $14.34 billion. So a slight beat on both of the Q2 numbers. And then they, as far as the individual segments are concerned, they were mostly good. They were a little bit light on a year-over-year and quarter-over-quarter basis for their studio stuff, but that is as a result of really good movies last year and last quarter. Hard to compare it to. So, are well-performing movies there. They had Star Wars and they had Black Panther that performed that they did not have in the most recent quarter. So, mostly good quarter for Disney.
It was quiet. It was quiet action on anybody who was doing the straddle. Probably got the beats on this if they were buying a straddle or if you were buying calls or buying puts, because the stock's really gone nowhere. I mean, it's trading up. It was trading in the red a little while ago. The market is down, so everything is, the majority of stocks when I look at are down, so the relative strength on this is pretty good. It's holding up. I think there's underneath demand. I'm going to say it again. That's why I pulled the trigger and bought some. I was hoping for a dip so I could buy more. I did not get that dip. It obviously went up. So, I'll probably stick with what I got. If this thing does eventually come back down to the 125, 130 area, I intend to buy more shares. I don't know if I'm going to get it, but at least I got a piece if it continues to run. This story is the opposite of Intel. This story is one that is actually, and Tim Seymour talked about this last night on CNBC Fast Money too. So not sure, maybe Tim's listening to our show. He does come on our show every once in a while, but I've just been talking. I mean, it's obvious, talking about the expanded multiple potential here for Disney if they start to give a valuation to their streaming service like they do to Netflix. So there's possibilities for multiple expansion here on Disney, and that's why I like the story. I like this story right now. It's got some good stuff going on. It always was a value stock, but now it's got a little bit of potential, maybe growth or maybe a story behind it as well. And a good story can take a stock a long way. I like the streaming service story.
Good call on this one. Someone got real excited when they took this up to 138.19 off the report, but I'm just going to drill into the dailies here. And traders should be aware that the 1, 2, 3, 4 last 5 highs have all been in the 135 handle, and they've ranged up. So I would just keep an eye on it. If it could get, 136 bid here and, a strong bid in a weak tape here, maybe you'll get up to that 138 area. 138.17 was your May 1st high. I just think it's a question of whether or not those sellers ahead of the report over the last 5 days are going to be there. Again, I mean, we're up 61 cents at 135.60. We're bid here. So potential for a launch. I just want to see what happens at 136.
Real quickly, let's do imbalances before we grab our guest today. Anything of note?
Crickets. I'm trying to look. JV Spec, you see anything? Because he's covering different stocks than I am. Man, G 120. It's small. It's small to the sell side. G 120,000 to sell.
It's tough, man.
I see nothing. Baba 35,000 to sell. It's just small. They're too small.
Third, right, what's this? His third down open in a row here. I mean, a big,
well, we got the wild card. We don't know what's going to happen. So overnight here, and we're going to find out more overnight, right, with the Trump situation, correct, and the tariff situation.
Your guess is as good as mine. Sure. Yes.
We're supposed to, aren't we?
We're supposed to by tomorrow. So, or tomorrow at some point tomorrow. But who knows at this point? Anyway. It's 8:34. Let's grab today's guest, Greg Weldon from Weldon Financial. We'll be right back in a moment here with Greg. All right, welcome back, everyone. Pre-market prep, Spencer Israel, Joel Elconin, Dennis Dick, as promised, joined by Greg Weldon from Weldon Financial. Greg, how's it going this morning?
Great. How you guys doing?
We're doing well. We're doing well in this volatile market there. I like your picture in the back. Is that from the gold pit?
Yeah, it's actually, that is from the gold pit. It is from 1983 when I first started working down there. So a lot of my friends are in this picture, and it's kind of old school. You know, I mean, I got my job just off the cuff visiting the Florida Comex. We talked about this before.
Yeah.
Because I'm 6'10", and that would give me no advantage in this day and age. So, you know, keep it up there for old school
That's
reminder.
Right. By the pit clerk that you could be, everyone could see your signals and get your
That's right.
orders into, right? And then
I could hand paper over people's heads. I could see to the back of the booth. I could reach down into the pit, you know, elbow people out of the way, box out. You know how it is.
That was like the co-location advantage today. I mean, they all get co-located so they're close to the exchange. You had the visual, so you had the total advantage. That's a huge edge.
Yeah, it was. It was good times.
You could
Good
pick
times,
off
for sure.
the orders.
When the S&P started, I was on the floor. The S&P 500 like basically started trading while I was, you know, when I first started in the business. So, you know, that makes me the dinosaur of the whole crowd here for sure.
Just wait a second. When you're talking dinosaurs, you got to include me. But another big advantage of being tall like that is that you could see the orders rolling in off the other desks even before they got to the other pit clerk. He'd be, you know, you could see that, be like, hey, Goldman's selling 200, you know, and then boom, 200, and it'd be a good offer. But those advantages are gone. But we always like your perspectives on the markets. And we got kind of a young crowd here, so I don't know if they all remember One Flew Over the Cuckoo's Nest. But you're calling this your special from yesterday. Not the Nurse Ratched, but the Nurse Ratcheted market. Go into details a little bit. Why you're describing that market as that?
Right. Well, I mean, the first thing I think you got to do is, you know, take a step back and get some perspective on this market. This market is up 27.9% from trough to peak from Christmas Eve in 4 months. Now, I mean, the math is, extrapolate that out. You're talking about almost a 100% annualized rate of return over the last 4 months. That alone just almost mandates you got to start thinking about taking some money off the table. Then when you take another step back into the macro world and get a view there, this market's kind of built on what I perceive as two things. Number one, the thought we're going to get a trade deal with China. And number two, that the Fed's going to cut interest rates. Well, let me tell you, the Fed's not going to cut interest rates anytime soon when you're pumping out a 3% GDP number and the unemployment rate is at a record low. Now, I will trash that unemployment rate as being a sign of the strength that people want to make it out to be, number one. But the fact of the matter is you are at least a step or two away from the Fed really even moving towards a bias towards easing. Now, what's interesting about that is the stock market has rode that wave because the fixed income market is pricing it. When you look at the Fed funds futures for the end of this year, they're below 2.25, which is the low end of the current range. That puts them 20 basis points below the effective Fed funds rate of 240. The Fed funds market is pricing in an ease by the end of this year. Then you look at the Treasury market. I mean, the 5-year note was pressing 3%, back in August, and now it has spent the last month and a half or so below the effective Fed funds rate. The 5-year note Fed funds effective Fed funds rate, that curve is inverted. You don't see that very often. The fixed income market is pricing in a rate cut as a certainty. And if the stock market has built its, this 30% rally somewhat on the back of that, that is something that might not happen anytime soon. It might actually, require a decline in the stock market to force the Fed's hands if that's what you think, is supposed to happen. Then we can talk about a trade deal. If it doesn't happen, clearly that's a big negative. There's no doubt about that. But Joe, even if it does happen, we're talking about something, the trade deficit less than 2% of US GDP. This is not going to result in something that will be an engine of global growth. It will be a nice boost. You might make new highs on that just from a sentiment standpoint. There will be some positives in terms of, capital investment, which has been kind of weak. But in terms of this being an engine of global growth, in terms of this being considered something that is like stimulus, like the tax cut was, I just don't see it. So when I kind of look at that, juxtaposed against where the market is and what it's built upon, I think caution is the tone for me here. And that gets back to Nurse Ratched, because you remember from the movie, it's One Flew Over the Cuckoo's Nest. It's a bunch of nutcases. The Nurse Ratched is tasked to medicating them. So it's kind of like you need to kind of medicate this market a little so it doesn't get out ahead of itself.
All right. You like to check under the hood. We look at it individual, everyday components of the big indexes. You like to look under the hood in the overall market through your quant work here. So, we talked about, a couple stocks, technology stocks leading the charge here. To you, is this or was this a broad-based rally?
It was not a broad-based rally. And the quant work you're talking about, we do the macro, so it's all fundamental. And then we, kind of want to see the quant and the technicals, gel. I mean, you want these things to kind of meet in the middle and meld. And in this case, it's been a very narrow rally. Okay. You've had, the obvious negatives. Healthcare and energy have been quite negative. In fact, when you break down to the individual shares in the S&P 500, versus the leadership. And it's just not broad to where if you're at new highs here, you might expect to see at least half the stocks trending bullishly. We haven't seen that. It's been barely above a third at the highs. So to me, that's a lack of breadth. And, again, the other thing is when you look at some of the technicals here, you have brought everyone back into this market. The ownership numbers, if you look at the volume, look at the on-balance volume, you look at some of the money flow, this market is, again, hugely owned. And I keep asking myself, what is the next thing that's going to generate another 15, 20% to new highs where you actually have new highs that have momentum behind it? Because this move to new highs has fizzled in terms of momentum. So you got a lot of divergences. You have a lack of quantitative breadth, and you have some activated landmines out there from a macro perspective, which we could talk about, at length.
All right. And also you like to, take a look at not only the U.S. markets, but the Canadian markets as well here. And you seen anything big, better in Canada or Japan or what's
No,
driving those
Japan
markets?
looks poor, outright poor, because you have a lot of, components. You're looking at steel, you're looking at non-ferrous metals, you're looking even construction materials. All these sectors are acting very poorly in Japan. Same in Canada. It's kind of almost a 50-50 split. You got financials acting well. And the other side, you got anything that's linked to energy or resources not acting well. When you talk about global, I still am concerned about Europe, guys. Really nothing's changed there, except the fact that you've had this big, nice economic run. Germany was a juggernaut, exporting 100 billion euro for 19 months in a row. That fed through to Czech, Hungary, Poland, providing semi-finished goods to Germany to finish them, to export them. It was a nice feed-through pipeline that was supporting a lot of economies in Europe. You had Spain, another place very strong, great employment numbers, great retail sales, had a little bit of inflation. And for me, the ECB missed the boat here. They could have raised rates last year, even taken them to zero from -40 on the official policy rate. And this way it would have given them a little ammo here. The Fed's done a masterful job in, restocking their war chest for whatever, situations they may face in the future. The ECB has done a terrible job of this. The first question is why? What are they afraid of? But then you start to break it down. And a place that concerns me, guys, really is there's two of them. First is Turkey. We're not out of the woodwork there yet. You had a local election, Istanbul mayor, the opposition party won. Erdogan, basically put his foot down and stomped out that result. So you have some turbulence there. The Turkish lira has gotten loose again. Bond yields are up there. You got a 24% interest rate. It's kind of choking the economy there. And that feeds through to Europe because Spain and France have huge loans into Turkey. And we know Spain, let's not forget, Spain is a country that had to include separatist parties into their coalition last year when the socialists took power. You have what is still a very tenuous and potential powder keg in Europe, and it could feed through from Turkey into Spain. Now, the other place, if I were to tell you guys, Nigeria is having a big problem, and Nigerian Naira is at risk on the downside. That might get some headlines. People might care, right? If all of a sudden Nigeria, a major OPEC producer, kind of a swing producer, was having problems, right? Well, how about if I were to tell you Angola is a situation that is kind of a mini powder keg? You say Angola, who cares, right? Well, frankly, Angola produces more oil right now than does Nigeria. Their currency has depreciated about a 40% a year rate for the last decade. The purchasing power of the Kwanza, which is their local currency, has just been trashed. And this is a place now where you can't use the local currency to buy goods and services. So when you start talking, why do I mention all this? I mention because the dollar is still at a level that looks like it's almost a launching pad to the upside. And that goes against the grain of what fixed income is telling you, that the Fed's going to cut rates here. So all of this plays into me to kind of bring you back to there's risk of the dollar moving to the upside here that could cause, some deflationary risks to kind of come back onto the Fed's radar. So there's a lot going on, man. And this is why we get up and love doing what we do every morning.
And what about, having your expertise starting in the gold market here? You think with all these, global worries here that gold would catch a bid and just a trading range here? Do you think it's just people are finding other ways to hedge their portfolio, or what do you think about? I mean, it's going nowhere to the trading.
It's a great question. I mean, it really is kind of the question. It's one I get asked a lot, of course. I would actually counter by saying gold holding here is phenomenal performance in the face of kind of what we got going on. I mean, stocks. I mean, who's invested in gold? Nobody, right? But there's two things I'll give you on gold. In the Angolan currency, gold's at a record high. In a lengthening number of currencies around the world, and I mean talking in the last 6 weeks or so, gold has exploded to record highs. All right. And in fact, when you have kind of the dollar on the verge of a breakout, the dollar is up year over year, at some points here in this rally, double-digit numbers, and gold is not breaking down. It has really diverged from its normal correlation with the dollar, which actually would put gold somewhere between 1050 and 1150, not at 1275 to 1300. So to me, gold's performance has been outstanding given the backdrop. And if and when the Fed does kind of have to come back into play, and they will, because if you have a problem in Europe, what's the ECB going to do? Nothing. And if a problem is a dollar-based problem, it will be on the Fed to address that. So from that perspective, I think the dollar could spike up, but that would be kind of a catalyst to shift the Fed even further towards a bias to ease, and that would then bring the dollar down, and that would be very bullish for gold. So it's kind of a waiting game and kind of a race against time for gold bulls. But I would say that the action in gold, as long as it holds above 1266, is phenomenal.
All right. So just overall, just very, very cautious on the market at these levels, perhaps hedging or other things along those lines, or your recommended course of action. Don't sound very bullish here. So I guess any downside targets in the market?
Well, I mean, I think if you start looking at the NASDAQ anywhere, 7,000 all the way down to 6,700, medication time means, take a chill pill. It doesn't mean, bail out and, we're looking for, Armageddon here. I think a correction's in order. It's just that simple. So I think, we're advising our clients to take profits and to, maybe look to re-enter the market on, some kind of Fibonacci based. I mean, the Fibonacci's on this, the ratios on this rally match very well with the long-term moving averages. So in the 6,700 to 7,000 area in the NASDAQ, we like the NASDAQ better than the S&P. I think that would be, a point to look at. The question becomes, what's happening when you get there? And why are we there in the meantime? Because to me, I mean, frankly, I'd rather be long China if there's going to be a trade deal. I think that's a real opportunity. Chinese consumer, the Chinese tech area still looks, pretty solid. I mean, obviously, they've taken a big hit this week. But if there were to be a trade deal, I think it's much more beneficial to the Chinese shares than to the U.S. So we like some of the Chinese ETFs, if and when that becomes more clear as to what's going to happen there.
All right. Are you going to be anywhere near New York City on June 20th?
In fact, I may well be. Why? You having a big party? June 20th? I'm all in.
We are having the first Benzinga trading summit. And we're going to be in New York City. Dennis and I are going to be out there. Spencer's going to be out there as well, running the pre-market show. We're going to have several, short-term traders, also some major investors coming, making comments on the market, just kind of getting in there, kind of showing what we do, what other traders do, how we look at the markets on a short-term and long-term basis. So I'll send you an email with more of the information. We'd love to have you out there. You got a lot of enthusiasm, and I don't know how many good old floor traders are going to have there. So I like the camaraderie. I'll send you an email later on today. Thanks a lot for coming on. Great information.
My pleasure, guys. Have a good one.
All right. Thanks a lot, Greg. 8:49 here. Joel, what's the word here?
We're sinking, Spencer. There's nothing that it's just sinking. We're down 27 and a quarter handles, 28.60. We took it. We're below Tuesday's low. I have nothing until 28.44.50, and that's 15 handles away here. So, barring a positive tweet on a trade deal, that's where I think we're heading today. On a rebound, I don't even know. We're just slowly sinking. If I guess 28.72. If we can manage to get back to that area, that would be halfway back on the session. But just big sellers here in the pre-market.
Yeah, that's what we're seeing here, and it's just continued to sell off. But we saw yesterday, and it just takes one tweet to change things around. So everybody is watching the Trump Twitter feed like a hawk, and I mean that's what's going to move. And if there is a tweet that says, "Hey, we're talking here," the market will just rally 30 handles in your face. So headline risk market here right now. So it's very difficult, like we said yesterday, to trade things technically when you're so headline driven. And we said that yesterday at the beginning of the show, and then boom, we got a headline at the end of the show and it rallied 20 handles in 10 seconds. So you got to be very cautious if you're trading out there right now, just on a technical basis with so much headline risk.
Yeah. Okay. All right, Spencer, we got some more earnings to cover.
We got a lot, and we're not going to get to all of them. So I'll run through a couple of major ones here. We didn't do ROKU yet, so let's do ROKU. They reported yesterday. The Q1 EPS here on ROKU was a 9-cent loss versus a 25-cent loss estimate. Sales of 206 versus 191 million dollars. Their Q2 sales guidance was higher, 220 to 225 million is the range they gave. 220 was the estimate, and this one just keeps on ripping.
It's holding on to the gains, which is a good thing, because this report after the bell, now you've had the entire 3.5 hours of after hours trading, plus the whole 4 hours and 51 minutes we had since pre-market opened at 4 o'clock. So you've had quite a few hours of trade. You trade a lot of volume here, so it's held on fairly well. I will say a word of caution again. We saw this with EA yesterday, not comparing ROKU to EA whatsoever, but we were cautious on EA, saying you're in an environment where they're looking to sell stocks. And when the market opens at 9:30, there may be some money managers looking to raise cash and saying, look, I'm sitting up nicely in this ROKU this year. It's over doubled. I'm going to take some money off the table on this pop. So I wouldn't be surprised if some of it does fade. I don't know if it's going to pull an EA and give it all back. I'm not saying that. And EA did give it all back. But I don't think I'm chasing anything up 10% in a market that everybody is all of a sudden nervous.
And boy, I tell you, it's $71. It's holding 71. I would say when I was looking at this yesterday, I'd say, hey, that's resistance, a pair of highs, 70.92 and 71.30. We're trading about, we're right at that 71.30 area here. So for you, have no fear of buying a stock up 10% here in a down tape. Better hold 71. After 71, I really think it could give some things back. That's a good swing number. And then you just go to your dailies and you see 73.17 and then that all-time high at 74.35. But wait for that shake and bake at 71, because I think if that holds, I think you'll be selling on weakness as opposed to strength in ROKU.
It's amazing how, just in one tweet over the weekend, everything changed.
Isn't it?
It's one tweet. I mean, we're at all-time highs and everything was, looking good from a technical basis. And one tweet changed everything.
How does that make you feel about being like this investment?
It makes you, it kind of, I mean, it just shows this market how driven it is. And looking for the next headline. And there was some nervous people out there. And I mean, obviously, we sold out and then we got a little bit of it back, but that ended up, that rally that we had, I believe on Tuesday was obviously, or whatever day it was, when we came back, quite a bit of the losses was sold immediately. So, and now we're sitting back down here near the lows of the move. So after the 600-point Dow down day, and we're right here at the lows of the move again. But it makes me it makes it tough. It makes it tough to be a trader here. Just trading because you don't know when that next headline is going to happen. I mean, right now, all that really matters is Trump's Twitter feed. That's a crappy thing to say, but in the short term here, that's kind of all that matters. I mean, yes, there's individual stories. Yes, there's individual stocks. But for the overall market, it is right now matter what is happening with this trade deal and what is Trump going to say next. So we're right back to Trump's got, if he wanted to, have all the glory here and all the power, he's got it right now, at least in the markets.
What about the comment that Greg made regarding the overall impact of, even if a deal's made at like percentage? Did you catch all that? I have to go back and listen.
Well, no, because my Skype call dropped 5 times during Greg's thing. So thank you, Microsoft. But anyway, so I did miss some of it, but enlighten me here. Like, give me your thoughts and then maybe I can come in.
It was just that, there's such an emphasis on it, but if you break it down to the total percentage of our GDP and everything, that it's significant, but that he just pointed out that it's not so significant that everything in the market depends on the deal with China. And even if the deal does go well, it's going to help certain segments of the economy, but it's not like this panacea, to get 5-6% growth. So that was the only thing. That was the only point that he made. But let's try and do a good earnings report. I feel like we're kind of Debbie Downers today. How about the
Tapestry,
the company formerly known as Coach?
Yeah, Tapestry is probably the best report of the morning here, up 20-ish, 17% TPR. Q3 EPS for them, 42 cents, adjusted EPS, 42 cents, beat by a penny. Sales 1.33 versus 1.34 billion dollars. So essentially in line on the earnings for their Q3, but they also report $1 billion buyback. And this
was set up last night too, ahead of the report.
Yeah, and they had a bad quarter last quarter, or 2 quarters ago, I guess. So this is a nice recovery for them.
Anyway, so it wasn't really down yesterday, but after hours, I did notice somebody trying to buy stock aggressively. So good job after hours, trader, because it's up 5 points here now.
35.75, trading up $5, 16% on the day. Just made a high at 36.50, and that is my level for the day, folks. Since that gap down in February, your highest level has been 36.55. If I was on, that'd be a good enough target for me. If you're looking for more, there's nothing technically to say that there's anything stopping it. There's a gap up at 38.68. That's almost another $3 from here. So I don't know. I'd be tempted to see what happens at that pre-market high, coincides with the daily high. And I mean, if you want to keep holding on to this and wait for the gap fill, it's be a brave trade here. So I'm looking at potential resistance right now.
Sticking with retail, we'll just run to the ratings for a second. There's not a lot of that interest in me this morning, as kind of everything is a reaction to earnings season. But RBC did put a pair trade on. They're upgrading Ralph Lauren to outperform, and they are downgrading American Eagle to neutral.
AEO is going to be down significantly on this. It's already offered at 20. So you say, $22.92. It's offered at $22.05, $22.19, $22.47. Nobody's lifting any of those offers. Tells me it wants to go under $22. So if you're long, hate to be the bearer of bad news, but this looks like it's going to go under 22 here today. We do have retail earnings season coming up. As we get towards the back end of it, we're going to start to hear from some of these retailers, and obviously that's all that's going to matter at that point in time. But right now, this stock doesn't look that great. Ralph Lauren, on the other hand, was starting to look broken. You get an upgrade here. A lot of people underwater. I think you probably have overhead supply issues, so I don't think I'm coming in here and buying this. And at 126, I mean, it's not up much for the upgrade, but you get up to 127, 128, 130. I'd love it to get up to 130 just to short it. So that's telling you that I'm not that bullish as our friends at RBC.
Pair of lows at 22.04. This was back just at the middle of April. So there are 2 daily lows there. The way Dennis is talking, the way the book is stacking up right now, those buyers better get there pretty quickly and defend that level. If not, let's look for the mid 21 handle. I see a low at 21.78. I don't think I'd be sticking my neck out there. But then I do see 2 lows at the 21.20 area. So that's another be down $1.80 from the close. So I like to see, I call 21.19, 21.20, 2-star level, 2 lows in that area.
In for AEO.
AEO and Ralph Lauren. I mean, I don't know when they report. Let's see, it's up $1.61. So if you're a big believer in this company, in Ralph Lauren and the upgrade here, you got a pair of lows to lean on, 122.86 and 122.73. So there you are, 2 lows in the same area. You're $3 above there, $3 and change. So I'd lean on that for a stop out level. On the upside, we're trading 127.27, your 2-day high, another potential target on the upside.
All right, 9 o'clock. So that'll wrap it for today. I'm sorry we couldn't get to more earnings, but them's the breaks. Thank you to our guest, Greg Weldon. Thanks to all of you in both our chat rooms, both on YouTube and premarket.benzinga.com. That latter chat room is active even after the show. So pop in there if you haven't already and check out what's going on there throughout the day. Chat with the fellow listeners of the show. Want to remind you folks, as Joel mentioned, the Benzinga Trading Summit coming up June 20th in New York City. You can get tickets at bztradingsummit.com, or if you want to go specifically to the trading room, go to bzprofit.com. That'll get you a ticket to, or buying a ticket through that will get you into the trading room, live trading with Joel, Dennis, Jeremy Newsom, and Marie Band, a few others as well. Promo code for that, PMP15, gets you 15% off any ticket. Again, PMP15, bztradingsummit.com. Last words, please remember all the information from our show is for informational purposes only, not meant to be investing advice. And now, everyone have a good rest of your day. Good luck, stamps.com traders, and we will see you on Friday.